If you've got private health cover, look closely at your next renewal notice, because from the 1st of April 2026, your premium is going up. A family on average price gold hospital cover will pay about $330 more every single year. CanStar 2026. And here's the part that should bother you. This rise was quietly signed off by the Federal Health Minister after insurers lobbied and resubmitted their applications. This isn't a market forcing prices up. It's a decision someone made. This hits around 15 million Australians. Department of Health 2026. That's almost everyone with private cover. So today we're going to do three things. First, compare your fund's actual rise against the cheaper funds. Second, audit what you actually claim back versus what you pay. And third, check your real cost after the rebate. 3 moves: compare, audit, and check. Each one takes under 30 minutes and every one of them is free. Here's the headline number, 4.41%, Department of Health 2026. That's the average private health premium increase the Albanese government approved for 2026. It was announced by Health Minister Mark Butler, and it's the largest average rise since 2017, note, up from 3.73% the year before. The Conversation 2025. But here's the part nobody tells you. That 4.41 is an average, not a ceiling. Your fund could be charging you a lot more. 3 moves: compare your fund's rise against the cheaper ones, audit what you actually claim, and check your true after rebate cost. Each takes under 30 minutes, and all of them are free. So, how does this actually work? Every year, insurers submit their proposed premium increases to APRA, the Australian Prudential Regulation Authority, the body that checks each fund's financial projections, claims costs and reserves. APRA then sends its recommendations to the Health Minister, who has the legal power under the Private Health Insurance Act to approve or reject them. The Minister said he set out clear expectations and made insurers resubmit their requests multiple times. But in the end, he approved an industry-wide average of 4.41%, Department of Health 2026. And crucially, that's an average across the whole industry, not a cap on any single fund. Which means individual funds went much higher. For 2026, AIA Health Insurance got an approved rise of 5.98%, the highest. NIB was at 5.47, Medibank at 5.10, HCF at 4.96, and Bupa at 4.80. CanStar 2026. At the other end, GMHBA came in at just 1.98%, less than half the average. So on the same starting premium, a member of the highest fund pays a rise roughly 3 times bigger than a member of the lowest. Same headline, wildly different bills. Now the second layer, and this is the one that quietly drains you over the years. 4.41% is higher than inflation, which ran at 3.8% in the year to December 2025. The Conversation 2025. The government links the rise to the cost of hospital and medical services, which climbed about 5%. Department of Health 2026. In the 12 months to September 2025, insurers paid out more than $26.7 billion in benefits. Hospital treatment up 6% to $20 billion, and extras up 5% to $6.7 billion. Department of Health 2026. The catch? Benefits have been growing at about double the rate of premiums for 2 years, which is which is exactly what's used to justify the hikes. And that compounding is where it gets personal. Take a family on a $7,500 policy. Stay on a fund rising 5.10%, and that's about $383 added in year 1. Switch to a fund rising 1.98%, and you'd add about $149, a first-year saving of roughly $234 for the same cover, CanStar 2026 figures. And that gap doesn't stay still. It compounds year after year into thousands of dollars handed to a higher increase fund for no extra benefit. Here's a belief that costs people real money. The myth, as long as the government says the average is 4.41%. My premium can't go up by more than that. The fact, 4.41 is an industry average, not a cap. Funds got approved, rises as high as 5.98% and as low as 1.98 Department of Health 2026, CanStar 2026. Your personal premium can rise well above or below the headline, depending entirely on your fund. So let's put both costs side by side. On the average rise, a family pays about $330 more this year, CanStar 2026. On a higher than average fund, that same family could pay closer to $450, author's estimate. Same cover, different fund. And remember, that difference doesn't happen once. It compounds into thousands over the life of your policy. Let me show you what this looks like for a real person. Meet Sarah. She's 38, a full-time teacher in Sydney, earning about $95,000 a year. She's got a partner, 2 kids, and a family gold hospital, an extras policy costing around $7,500 a year. She's 29 years from retirement. Here's what Sarah found when she actually read the fine print. First discovery, and it's the number that started it all. Sarah checked the official insurer table and found her fund, Medibank, had an approved rise of 5.10%. Not the 4.41 she'd seen in the headlines, CanStar 2026. On her $7,500 policy, that 5.10 adds about $383 versus $331 at the average rate. An extra $52 this year alone. And if her fund keeps running ahead of the average, that gap becomes thousands over the next decade. Second discovery. When Sarah compared funds, she found GMHBA had an approved rise of just 1.98%, less than half the industry average, CanStar 2026. On her $7,500 premium, that's about $149 added versus $383 on her current fund. That's roughly $234 saved in the first year alone. And if that gap held over 5 years, the saving climbs past $1,000, authors modelling. Third discovery, Tosti, and this is the one that reframed everything. Sarah read that hospital and general treatment benefits rose 5 to 6% in the year to September 2025, and premiums are being set to keep pace, Department of Health 2026. But inflation was 3.8% and her likely pay rise around 3%, The Conversation 2025. Run that forward 10 years, her income would be about 34% higher, but her premium about 54% higher, authors modelling. Health cover quietly eats a bigger slice of her pay every single year. Now add it all up across Sarah's working life. If she stays on a fund rising about 5.1% a year instead of switching to one rising around 2%, the difference over 29 years to retirement lands somewhere between $40,000 and $60,000, authors modelling. To be clear, that's an illustrative scenario, not an official projection, using a constant rate and ignoring policy changes. But the lesson holds. The fund you pick today compounds into tens of thousands tomorrow. So, could this be you? Sign 1. You've never checked your fund's actual approved increase, only the headline number. Sign 2. You don't know how much you claimed back last year. And sign 3. You haven't compared funds since the day you first signed up. If even one of those rings true, the next 3 moves are for you. This is general information, not personal advice. 3 moves. Let's do them. Compare, audit, and check. And you'll know exactly where you stand before April 1st. Move 1. Compare your fund's rise against the cheaper funds. Start on your latest renewal notice or online account and find your insurer's name. Then head to the Department of Health and Aged Care's 2026 Private Health Insurance Premiums page, which publishes each insurer's average increase from the 1st of April. Look up your fund and at least 2 competitors and cross-check against an independent table like CanStar's. If your rise is meaningfully above 4.41%, shortlist cheaper alternatives and request quotes. So, 3 quick steps. 1. Answampi. Find your insurer on your renewal notice or online account. 2. Look up its 2026 rise and 2 competitors' rises on health.gov.au. 3. Request quotes if yours is above the average. What good looks like. Your fund's increase is at or below 4.41%, ideally closer to 2 or 3. Move 2. Audit what you actually claim versus what you pay. This one's especially powerful for extras. Log into your insurer's member portal. Every APRA-regulated fund has to keep transparent claim records, and download your claims history for the last 12 months. Then compare the total benefits paid to you against your annual premium from your renewal notice. If you're claiming far less than you pay, it's time to get quotes for hospital-only or lower-tier cover from other funds. 3 steps. 1. Download your claims history for the last 12 months. 2. Compare benefits paid to you against your premium. 3. If you claim little, quote, hospital-only or lower-tier cover, what good looks like. Your claims each year are reasonably close to or exceed the extras portion of your premium. Move 3. Check your real cost after the rebate. Premiums are quoted gross, but the private health insurance rebate cuts what you actually pay. The government expects to pay around $7.9 billion in rebates in 2026, Department of Health 2026. Use MyGov and the ATO to find your taxable income, then look up the rebate percentage for your income tier and age. Apply that to each fund's gross premium so you're comparing net cost, not headline numbers. 3 steps. 1. Check your latest taxable income in MyGov. 2. Find the rebate percentage for your income tier and age published by the ATO and Department of Health. 3. Apply it to each fund's gross premium for a true net comparison. What good looks like. You know your rebate tier and your net annual cost in real dollars. Why does this matter right now? Look at the timeline. Back in 2017, we saw the last comparable spike. The 2026 rise is the largest average since then. The conversation 2025. In 2024, the government re-indexed the rebate income thresholds to keep more people eligible as premiums climbed. Department of Health 2026. And in 2026, the 4.41% average was finally approved, after insurers were sent back to resubmit their applications multiple times, with rising hospital and wage costs cited as the reason. The hike lands on the 1st of April, so the window to compare and switch is open now. Once you've acted, here's how to confirm it worked. You should see your new fund's lower approved rate right there on your quote. Confirm that your cover tier and any waiting periods are matched or properly waived, so you're not losing protection. And if your net after rebate cost dropped while keeping the cover you need, that's the win. The switch paid off. Everything today comes from the Department of Health, APRA's assessment process, the Conversations analysis, and CanStar's fund-by-fund tables. All the links are in the description below so you can check your own fund. Today you learned why 4.41% isn't a cap, which funds went higher, and 3 moves to cut your bill. Next week, hear the private health rebate and whether you're stuck in the wrong income tier. If this saved you money, mates, or just saved you from autopay on a 5.98% hike, subscribe. We read the fine print so you don't have to.